Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula, registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC. Thanks so much for joining us, and welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Dave Ross and myself. My name is Chris Swan. 419-794-3030 is the phone number. Once again, that's 419-794-3030, online, arhq.com. Today on the show, is it time to take some profits from the stock market? We've got the drawbacks of aiming for a certain amount to save for retirement. And should you wait to take a Roth conversion? All this and more. But first, let me check in. Dave, it's just you and me today. How you doing, sir?
I'm good. How are you today?
I'm doing well. You know, it is that time of year. School has started back up. My son is asking a lot of questions. They're learning things that I certainly didn't learn, and not in the methods that they learned, as they're doing it now. But it just goes to show you never really stop learning. You get a little bit more insight. And if you don't have the answers, don't be afraid of where to turn. That's kind of what we're here for, to help enlighten the listeners and to show them they may not have all the answers when it comes to their retirement. That is actually okay, because that's what we're here for. I want to remind everybody out there, all the previous episodes of the show, including segments and questions, available via podcast, Spotify, Apple Podcasts, YouTube. Just search for America's Retirement Headquarters. All that education there at your fingertips. But let's go ahead and dive right in with this. If you shop around, you still might be able to find CD rates in the neighborhood of 5%, but there's actually a 9% CD that is out there being offered by a credit union based in Seattle. There is, of course, a catch. You have to be a resident of Washington State, so probably not that helpful for us. But with the Fed expected to lower rate in September, CD rates likely going to head down. Are you telling clients to lock in what high rates they can find right now with fixed assets?
There's a couple different ways to look at fixed income. And I will say this, a lot of folks in their 401ks and in their personal investments have utilized bond funds over an extended period of years. And I would go on to say is that bond funds have kind of been knocked around a little bit, because you get that usual bond, I call it the teeter-totter effect, where if interest rates rise, the prices of the underlying bonds drop and vice versa. So in this, from 2020 on, bond funds have not performed all that well, but similarly, treasuries and corporate bonds, where you can actually go into the open market and buy them, have been extremely attractive, because you know what rate you're getting in. And because it's a government program, you're going to get your principal investment back at the end of the bond. So I would say that, this is a good time to be looking at trying to lock in some high rates. The caveat with that is you have to be willing to live without the money for the length of the term of the bond. You're almost forced to keep it until it matures, because if you try to sell it in the open market, people will make lowball offers and try to buy it for a lot less than what it's truly worth. Talking about the Fed dropping interest rates in September, I believe that could happen, but I'm also a little bit skeptical, because we're in a presidential election year. Mm-hmm. And quite honestly, that becomes a political topic. I could see the current administration wanting to take some credit for interest rate drops. So I think the conservatives would say, oh, no, we shouldn't have any action on interest rates until after the election. I think it will be very interesting to see if that actually plays out that way. But I believe that once the interest rate cutting cycle starts, I see it continuing for a little bit.
It's one of those things where at the beginning of the year, even at the end of last year, they were predicting, six to perhaps even more cuts in 2024. Here we are, in August going into September. Nothing's happened yet, but rates also have not gone up. So we've had this conversation in the sense of it's a good time to lock in rates. And that, I think, remains true. We haven't quite gone on a downward trajectory, but we've sort of plateaued. So rates have held where they are right now. So, but all signs point to at some point in the future, they are going to go down. Think back to when interest rates were historical lows, people refinancing their houses. I'm sure there are a lot of people out there who are kind of kicking themselves or did kick themselves for not doing that, not locking in those low interest rates on, those loans, those refinances. This is the opposite of that. If you are looking at, parking some money in to take advantage of these, I really don't see a time in the future where, certainly hopeful, and I think you're in the same vein, where those rates probably will not be this high again. Hopefully, right?
Well, just think about people that would like to buy their first home.
Mm-hmm.
Mortgage rates are unbelievably high, and we really need to see some interest rate reduction for people to start putting money back into the real estate sector and people feeling comfortable and confident about taking on a mortgage. All of those rates, loan rates, but buying a used car. I mean, you talk about inflation.
Yeah.
And you look at the cost of the things that you're really spending money on, which are food, oil, and borrowing. Those are not consumer friendly rates right now, and it would be nice to see the market become a little more bearable for the people who are trying to get moving forward with those kinds of purchases, and so they can start planning the rest of their life so they can get ready for retirement.
You want to go ahead and at least take a look at locking in some of these great rates on fixed rate vehicles right now. And then if they do go down in the future, you don't have to worry about that regret. Seeing how it can work for you, it's one of the many things that the America's Retirement Headquarters does with the Retirement Team Action Plan. And so if you want to see if this could be a great time to lock in some rates, why don't you give a call right now, 419-794-3030. Set up a complimentary conversation, 419-794-3030, or visit them on the website, and that is arhq.com. It is one of the biggest mistakes people make when they leave their jobs. They roll their 401k over to an IRA, and it likely initially lands at a market type cash account that pays a marginal rate of interest. There's a new Vanguard study that found that nearly a third of rollovers were still sitting in cash 7 years later, missing out on substantial gains from the stock market. Here's wealth manager Ed Murphy on Yahoo Finance.
Unfortunately, it happens more often than it should. There's a couple things that you can do to avoid it. One is you can stay in the plan. So when you change jobs or retire, you don't necessarily have to take the money out and roll it to an IRA. Oftentimes, it's better to leave it in the plan and get the benefit of better pricing, oftentimes diversified products that you can take advantage of. But to the extent that people do want to roll it over, it's really important that you consult with an advisor so that when you do roll it to another institution and you roll it into an IRA, the money doesn't sit there. It actually gets put to work based on what your investment objectives are.
Now, I know when clients or prospective clients come in, one of the things that you guys do is offer that complimentary second opinion, taking a look. How often do you catch mistakes like this before it costs a new client too much?
Well, the first thing I want to talk about is I want to kind of respond to Ed Murphy's leaving the money in the plan statement. Mm-hmm. I had a situation several years ago where I met with a lady, and she let me know that she has had 5 different jobs over her lifetime.
Okay.
And every one of those 5, she left the money within the plan. And when I started doing the research on the investments held within that plan, I could pick, without looking at any statements, which ones were from the jobs when she was young, okay, which one is the current, because the risk level was wildly varied mm-hmm. from one plan to the next. And when you're in your 50s or maybe even your 60s, if you were at job number 1 for a long time, you might be really high on the risk spectrum in terms of where your money is invested. See, I think you need to meet with a professional, and I think you need to really craft not only the plan, which is the Retirement Team Action Plan, but you also need to have your investment policy statement of where you're going to invest your money crafted before you even consider a rollover. And I would say this, Chris, when we do business here, that's one of the things we absolutely have to do when we bring on a new client. We have to craft the investment policy statement. Since we are a fiduciary here at the Retirement Guys Formula, we have to be able to lay out how this rollover is in the best interest of the client. So having the meaningful discussions is very, very important. In fact, Nolan and I last week met with a gal who's going to probably be retiring in the next 12 months. And that was the whole synopsis of why we won the case, was because we put together the game plan of how her money should be invested. She liked each component of the plan. And then when we rolled the money over, we automatically earmarked funds for different investment strategies that we had picked for her. So, a fiduciary is required to do that kind of stuff. So I would be very embarrassed if I had a person retire and their money roll over into some kind of cash account. I will say, when are those rates likely to drop? And it could be sooner rather than later. So, you have to develop an investment strategy prior to executing the rollover. You want to go through the retirement team action plan, which is taxes, estate planning, money management, and asset protection. So you want to have those discussions. And you also want to take that retirement team action plan and implement it into our independent income system, because there needs to be sources of reliable, ironclad, guaranteed income sources, of which Social Security will most likely be one of them. But to make sure that when you retire, that all of your needs, your basic needs for monthly cash flow, are covered. And so that's what we do at America's Retirement Headquarters. It would be a time well spent for anyone to come in here and meet with the team and to start traveling down the road to setting up a retirement strategy that is tailored to their individual needs.
Because you definitely don't want to, have these 401ks, these orphan 401ks as they're called, especially as you mentioned, if you've got multiple in different jobs, maybe hard to keep track of them. What is the saying? Out of sight, out of mind. If there are fees and, a bad market performance due to your risk score, it becomes out of sight, out of mind, out of money. And you definitely don't want that. So taking charge of it and not just figuring out how to do it, but why to go about it. And very much that measure twice, cut once situation. The guys at the Retirement Guys Formula, America's Medicare Associates, America's Retirement Headquarters, they can help you craft that plan. And not just craft it, but explain to you the whys, the ins and outs, educating you, helping you make those informed decisions. It all begins with that phone call, 419-794-3030. Or you can go to the website and find out more about the independent income system and the retirement team action plan right there at arhq.com. If you ask 10 economists if we're heading towards a recession, you'll probably get 10 different answers. There are some people who even look at data from rather unusual sources like sales of men's underwear and even lipstick. We know you guys don't take these things seriously, but what metrics do you guys at the Retirement Guys Formula actually look for before telling clients we're veering into recession territory?
In my life previous to becoming a financial advisor, I was a business and an economics teacher. So I can give you a textbook definition. What is a recession? It's when you have 2 quarters of rising unemployment and negative gross domestic product. So what does that mean in plain English? It means that people are losing their jobs. So you see a lot of layoffs coming from corporate America. And you also see people spending less. Well, people are already spending less on big ticket items because if they have to finance them, the interest rates are cost prohibitive for doing that. But Chris, the unemployment numbers don't seem to be bearing that out. Mm-hmm. So I would say that a lot of people look at their personal situation and say, am I better off today than I was last year or 2 years or 4 years ago, they may think personally that they are in a recession. But in the broad scheme of things, our economy seems to be humming right along. When we look at investments here at America's Retirement Headquarters, what are we looking at? We're looking at highly profitable firms who have large sums of cash on hand, and they have products that are being bought on a daily basis by consumers. That's the thesis of what we're looking at in terms of a potential investment in one of our management strategies. The other thing that would be looked at by us here in the recessionary thing is, are any of our portfolios tripping what we call circuit breakers? A circuit breaker is where you have economic indicators that are failing to meet a certain level of standard, and that would trigger a certain percentage of a portfolio being liquidated to cash. That has happened a little bit here and a little bit there, but it hasn't stayed in that arena for very long. So in other words, we definitely have metrics of when we would sell out of things, but then when those metrics reverse themselves, we're getting right back into the market. So it's not like we're going to cash and staying there. We are not doing that. We're just continuing to see strength in, like you said, the companies that have high cash positions, low debt, and they have a product or a service that consumers are buying in large quantities. So when you look at the technology area and all this artificial intelligence, those investments continue. They had a little bit of a correction, but now they have kind of right-sized and are kind of heading right back down the middle of the turnpike. So I would say that recessions are largely what a person feels about their own situation. And that's another reason why I think time spent here with an advisor at America's Retirement Headquarters is time well spent, because we will analyze your situation. We will stress test your portfolio to see what kind of a risk quotient that you're involved in.
Because while we are beyond the point where it is a national economy, it's now a global economy. I've heard that said a lot. People really are most concerned with their personal economy. So as you said, while we may not be in quote unquote recession territory, if they're feeling the strain, that is something that definitely needs to be addressed. And that's going to vary from person to person. And that is why the plans you guys develop at America's Retirement Headquarters, they are custom suited to everyone's comfort level, what they're looking for, their risk tolerance, and things like that. I've had the pleasure of doing radio, doing this program with the team for going on 4 years now. And one thing that I really, truly admire is the fact that the messaging, the methodology for picking the right investment strategies, obviously the components are going to vary from time to time, but it's that same message, things with cash-rich reserves, everyday kind of necessities, things like that. And so making sure that having that consistency has really, I think, worked well for people out there. So if you have concerns about your personal economy, especially as we are in so many things beyond our control now, my challenge to you is to go ahead and reach out and schedule a time to speak with America's Retirement Headquarters, start developing that plan, have that retirement team action plan run for you, and take a look and see, if there are changes that need to be made. It's real easy. All you need to do, get started. Give a call, 419-794-3030, or go to the website. That is arhq.com. Now, it's no secret out there that volatility has certainly rocked the stock market lately. That's been especially true for tech stocks, like the companies that made up the Magnificent Seven, but those shares are still up despite the recent hits. Wealth manager Sandra Cho tells Yahoo Finance what her next move would be.
One of the best things to just know in your heart is that there is going to be volatility in the markets, and to accept it and then just lean on that diversification. If you've been in the Mag 7, if you've made that play with the AI stocks, good for you. There's been a huge run up. That said, at what point do you start taking those chips off the table and cashing them in?
So again, it comes down to taking that emotion out of it, which is easier said than done. Do you find it hard to persuade clients to, quote, cash in their chips on big gains, or do they put their trust in you guys for that?
They very much look to us to help them navigate when to sell, when to buy, when to rebalance, and when to adjust the risk level based on where they are in their either working or retirement journey. So, I will say this, I've been guilty of it, and a lot of people I think have been, where you can watch an investment run up very quickly, and then you start justifying in your own mind, oh, this can continue to go up. This can continue to go up. And the next thing you know, it reverses, and then it just becomes a downward spiral. And then people are saying, why didn't we sell? I've said it about my own investment. Why didn't I sell? It's very interesting. And I will tell you, this is an interesting little story about this. So when I was teaching school, I was preparing for my movement into the financial services business. And I had already received my New York Stock Exchange license, but I'm teaching, and there was a fellow who was a clergyman, and he donated his time to come in and talk to students that were attending the high school that I was teaching at. And one day he approached me in the cafeteria and he says, I understand you know something about the market. And I said, well, I'm learning about it, and I'm preparing to move into the financial services industry. And he pulls a list out of his pocket. And this was in 1999, which, if you remember back to that time, that was when the tech bubble burst. Mm-hmm. And so I'm looking at this list, and it was every tech company known to man. And it wasn't the big boys. It wasn't Apple. It wasn't Alphabet. It wasn't any of those. And he asked me what I think, and I tell him, I go, wow, you're really not diversified here. You've rolled all of your bets into the tech sector, and I would be very, very careful moving forward, because this could change in a very much of a hurry. And when that bubble burst, I had moved on to a new teaching assignment in a new school. And when the tech sector bubble burst, all I thought about was that guy. And I said, I hope he listened, and I hope he rebalanced his portfolio. Don't look a gift horse in the mouth. If it makes sense to sell, then sell. I would say that an investment position really consists of a couple different elements. If I owned 1,000 shares of a stock, doesn't matter what the company is, the decision I would have to make is, how many of those shares am I going to hold for a very long period of time? So let's say it's 500. And that means that the other 500 would be a trading position. So if that stock is currently trading at $100 a share, and they're saying that it's got a target price of 130, at 130, I would think I'm going to be taking some of those trade position shares off the table. So you should be selling. And then when prices readjust and you can rebalance the portfolio, you might be able to buy back into some of those names and buy them at a deep discount. But I also feel that a lot of people get in trouble because when they start thinking that they're behind in terms of how much they've saved for retirement, the most likely scenario is, maybe I should be saving more money, putting more money out of my paycheck into investments. But a lot of them end up taking a lot more risk. So how much of your investment is a trade? How much of your investment is for long term? You got to have your fundamentals lined up.
Helping you develop that plan is really what it's all about. We talk about diversification. It is not just owning a bunch of different stocks, because as we know, with mutual funds and things, you can be, vertically diversified where you've got a lot of the same positions in there, but finding things that maybe aren't necessarily tied to the market to utilize as strategies to protect when the market is being less than favorable, as we've seen volatility creep back into the picture lately. And more important than that, not letting emotions dictate your decisions, because that is almost a surefire way to make sure that you are going to make mistakes. Do the opposite of buy low, sell high, panic sell, and then maybe get back into the market at the wrong time, if at all. Having that non-emotional approach to it, having that discipline put into your plan, is as simple as reaching out and setting up a time to speak with the guys at America's Retirement Headquarters to do that, to start taking control of what you can control. Give a call right now, 419-794-3030. Set up a time to speak with the guys, or go to the website, and you can also find out about upcoming events and register for that as well at arhq.com. There are not many Tesla Cybertrucks out there, so when you spot one with that stainless steel boxy look, you definitely take notice to it. When Elon Musk first unveiled that EV 5 years ago, he priced it. He said it was going to be just under $40,000. Well, fast forward to today, the cheapest Cybertruck cost $100,000, so not that. If you delayed your decision to buy one when it was first announced, you now face a much higher rate. Delaying retirement, and a similar thing, delaying retirement planning can also be costly. How soon should somebody come in and start speaking with you guys?
I don't think there's a situation where it's too soon to start planning. Now, is it important when you're in your 20s and 30s to have an ironclad financial planning strategy? I would say at the younger ages, more of the discussion should be centered around, am I saving enough? Am I taking appropriate levels of risk? And does the level of savings that I'm putting away versus spending, am I living on less than what I'm making? And am I heading down a good path in terms of the debts that I have? So when you get into your late 40s and 50s, now you start looking at, you can see retirement in the headlights. And a strategy should be put in place at some point. When you have a young family, when you have kids when you're young, which I did not do that, you're going to be spending a lot of money on raising your family. And so you've got those expenses, but you're not really concerned about retirement. Well, I have youngsters at home. I have a 21, a 19-year-old, and a 17-year-old who's a senior in high school, and I'm of retirement age. I could retire based on an age thing, but I'm quite obviously not retiring because we've got 3 in college. We'll have 3 in college. So trying to traverse the family versus retirement situation is I think it's a slippery slope. So having this retirement team action plan really creates a roadmap on, let's just take a look at retirement and how I'm going to get there. What kinds of taxes am I going to face? There's a common belief that tax rates on retirement payouts are going to get jacked up in a meaningful way in the future. How could my estate planning be affected by government taxes and things like that? Estate taxation has been all over the place in the 21 years that I've been a financial advisor. Protecting your assets against situations where you'll have to spend down your nest egg because of a health concern or needing to be cared for in a nursing home facility. That's really is a hot button topic today. And people that do not have an asset protection strategy in place could run into a real roadblock when they start spending hundreds of thousands of dollars of their retirement savings when they get older.
It definitely doesn't need to be a set it and forget it approach. Obviously, the more time you have on your side to really take charge of your retirement planning, the more strategies, the more things you have access to. It's not to say that it's ever really too late. There may be more work that needs to be done. Certainly if you plan on retiring in the next, 3 to 6 months, there may be some things that need to change as far as that goes. But if you have not taken charge of your retirement yet, if you want to go ahead and get started, no time like the present, honestly. 419-794-3030. Set up a time to speak with the Retirement Guys formula. Start developing that plan. Once again, 419-794-3030. Or you can go online, schedule a time there as well, and find out more about the guys at arhq.com. Now, we spoke previously about whether or not we are in a recession or we're veering into recession territory. There are a lot of research groups that have done studies that show how we have a retirement crisis. So even though we may not be in that quote-unquote recession, it is still causing people to have a lot of concerns or feelings that they won't have enough money when they retire. David Blanchett works for company PGIM. His take is a little bit different on the retirement crisis. Quote, "What I worry about are these surveys that say you need $1.9 million to retire. When most people see that, they're going to think, what's the point? I don't have that. I might as well give up." He went on to add, "It doesn't take $5 bajillion to get to retirement and be okay. There is a middle ground. You don't need that much money. Certainly that would make it easy. But have you seen clients that are negatively affected by these stories? And do you have to undo some of the damage that stories like this, that Keeping Up with the Joneses has done to them?"
I think a lot of times it comes down to how much reading do they do and who are they listening to? You know, I'm running into a lot of folks who think Dave Ramsey's the gospel, and he's basically a very hard liner when he says, you need to spend less than you make, and you need to manage your debt, and you need to invest your money and not spend it and not, and you know what? I agree with a lot of that. But negative thoughts, I think whenever a person starts to fixate on a number, I think that we're already into a bad piece of road, because it's not about the number. It's about what can that number provide you. So whatever it is that you have, how can we make that work to sustain your lifestyle as best we can? And, you know, I guess I look at retirement, it's kind of like a three-phase scenario. When you first retire, you want to travel, you want to spend time with your grandchildren, you want to have a lot of fun. And I call that the go-go phase of retirement. Then as we start getting a little bit older, we might have some health afflictions that are slowing us down a little bit. So we may not travel quite as much. We call that the slow go. You might be spending a little more money out of your nest egg to help cover different healthcare related costs in retirement. And then the third phase is the no-go, where you're old and you're sitting around home. And I've known people, and I've been related to people that have been in all three of those different phases. And I guess the thing is, if you're in the no-go and you've got a health concern, you just want to make sure you're not having to spend all of your money down to be able to cover costs of nursing homes and or medical professionals coming to your house. Health is the number one concern in retirement. I think the number two concern would be the effect of taxes. What's our government doing? They're giving us incentives to work longer. Right now, you know, for many, many years, it was 70 and a half was retirement. And now it's 73. Mm-hmm. And then by 2034, it's going to be as high as 75. So they're trying to make it easier for people to keep working. Those who want to work, they would like them to keep working. So do I have my money positioned in case I have a health care situation? Do I have money in position to cover tax rates, whatever they will be? And then when all the costs associated with living are paid, do I have enough discretionary income left over to be able to do what I want to do? And that's exactly why the independent income system and the retirement team action plan are so important, because they really work together. The team action plan prepares you for retirement and assesses all the key areas. that you need to deal with financially in retirement time. And the independent income system deals with, will I have reliable income to cover my basic expenses? Will I have different buckets of money that I can use for different things that could pop up in retirement? And by creating multiple buckets of money, really creates a strategy that you don't have to, yes, you have to worry about whether or not you're overspending, but you have some safety nets in place where you can continue to draw from if an unexpected expense or something that comes up. And I would say this, when you work with an advisor from America's Retirement Headquarters, I would tell you that we help give you, and the phrase I call it is, we give you a judgment-free number. You share with us what you have accumulated and saved for in your lifetime, and we'll give you a number that you can count on. And we're not going to tell you, oh, I'm sorry, you can't retire, you need to keep working. We're going to take what you have and see how we can make it work for you and to create a plan that truly delivers on what you feel is most important when you look at your retirement.
With people living longer and longer these days, thanks to the advent in technology, there is legitimately a reality where people could be spending as much time in retirement, if not longer, than while they were in the working world. Now, that does come with challenges, obviously having to be able to fund that, and that can give concerns. That could be part of the reason why people feel like they may be in that retirement crisis. But with a proper plan in place, being able to talk about the different variables, obviously the government, making it so that people can work longer as long as they want to. Sometimes that's taken out of our hands. If you have a plan in place, you will know that, these things have been accounted for, these different variables, figuring out where's the income going to come from? How are you going to fund this? How are you going to take care of taxation, healthcare needs that may possibly arise? That is what you get with the Retirement Team Action Plan. That is what you get with the team at the Retirement Guys Formula and America's Medicare Associates. All it takes to get started, to start addressing these concerns, go to the website, arhq.com, click on the events tab. There's a lot of upcoming events where they discuss different things. That Economic Summit coming up in October, of course, is a great one to attend and really find out, their methodology. Or if you want to just get in front of them and set up a time right now, pretty easy, 419-794-3030. The phone number is 419-794-3030. Jimmy Kimmel has been hosting his late night show on ABC for 21 years now, but he tells the Politicking podcast that he doesn't believe the format will actually exist in 10 years.
Maybe there'll be one, but there won't be a lot of them. There's a lot to watch, and now people can watch anything at any time. They got all these streaming services. It used to be like Johnny Carson was the only thing on at 11:30. And so everybody watched. But now there are so many options. And the fact that people are able to easily watch your monologue online the next day, it really cancels out the need to watch it when it's on the air. And once people stop watching it when it's on the air, networks are going to stop paying for it.
This kind of ties into what we were talking about earlier, Dave. Many people fear that Social Security is also going to be gone in 10 years. That is obviously an exaggeration, but the program does face a possible 25% cut in benefits by then if Congress fails to act. So with knowing that there will be changes down the line, but not knowing what those changes are going to be, is there something that we can do now to help fill any potential gaps we may see?
Absolutely. When you start looking at our independent income system, the one thing that is the cornerstone or one of the main pillars of it is how much reliable income will you have at retirement time? And reliable income can come from Social Security. It could come from a pension. Even though pensions you're starting to see them less and less, they are still out there. How you take your retirement savings from your 401k and allocate it amongst different buckets of money that you're going to need in retirement, that also can be utilized as a reliable income source. And I think the one area that really needs to be discussed, and that is, what is the role of annuities in retirement. And I will tell you, when I came back into the financial world in 2006, I would meet with people, and this was a common comment that I was hearing from them. Talk to me about any investment that you have access to, but please, please, please do not mention the word annuity. And it was really kind of a catch-22, because in 2006, annuities were a lot different than they are today. They weren't necessarily generating income for a foreseeable future that helped people reach their goals. They were very expensive. And in some cases, the risks that people were being asked to take were well outside of their comfort zone. So that is not the case in 2024. And when we look at annuities, there's really three main types that can fit into your personal situation. The first one is a fixed annuity. And a fixed annuity is very simple. You give an insurance company a piece of your portfolio, and they will pay you a specified interest rate. And we've talked about earlier how interest rates are at an all-time high. They're at a high, but they're looking that it looks like those rates are going to be dropping. Well, if you were looking at a fixed annuity, now might be the time to lock that in, because the 5.5% interest rates are still sitting there. And if you could get 5.5% over a 5-year period, I don't think we'll be at 5% a year from now. We'll see. If this interest rate cutting cycle begins, when they say it could begin in September, you're going to see interest rates on fixed investments that are dropping quite a bit. The second type of an annuity is called a variable annuity, and that's for the person who is looking to accumulate money in a vehicle that is directly linked to the market. So you're taking market risks. You're picking a basket of investments that have a growth rate that hopefully will be considerable. If you're in the accumulation stage, a variable annuity may very well be a good choice for you, but that's something you would have to discuss with your advisor. The third one, and one that we're seeing a lot of activity in, is called an equity index annuity. And I will tell you, the good part of an equity index annuity is you get to participate in the positive returns of different indexes, different indexing strategies. But you don't necessarily participate in the bad side. So if you buy an equity indexed annuity and the market does a 10% of return, you could very well earn all of that 10%. But if the market drops 20%, the worst case scenario is your money stays where it's currently at. And Chris, I'm sure you'll agree with me that sometimes a 0% return is a very good return if the market is gyrating. There are also different benefits you can buy with annuities that offer protection. What I mean by that is they will cover you for certain levels of loss. And is that for you? It may be for some, may not be for many. So when it comes to annuities, we want to find out how much reliable income an annuity can develop for you. But we also want to be able to manage the risk. What is a risk appropriate level? And a lot of times the risk quotient determines what type of annuity you should be chosen for that investor. I would also say that on indexed annuities, sometimes those annuities have cap levels. They have a maximum cap which the investor can earn. So if you have an 8% cap and the market does a 20% return that year, you will receive the maximum cap, which in this case would be 8. But you're being protected on the downside. The worst case scenario could be 0, no loss, no gain. The other thing with fixed index are participation rates. Do you participate in the full movement of the index, which is 100% participation rate? So if you have 100% participation, you get all of the return. If you have 50% participation, if the market does 10% and you've got a 50% participation rate, you're going to earn 5. So equity indexed annuities are good, but they have a lot of moving parts. And I would tell you, you really want to know what you own. And here at America's Retirement Headquarters, we educate you. We inform and educate you about how these different annuity contracts work and how they fit into your plan. Another area that, last but not least, is annuities can provide asset protection against long-term care, nursing home, and catastrophic health care costs in retirement. So when we do the retirement team action plan and we get to asset protection, we may very well be having a discussion on how we can utilize annuities to help protect you from a rapid spend down of your retirement dollars to help provide the medical care that you're going to need as you get older.
And again, because there is such a wide variety of annuities out there and everyone's circumstances are different, you may not necessarily need one in your retirement plan. It is not something that is right for everybody out there. It is certainly not going to be the entirety of your retirement plan, but it could be a valuable part, especially if you have needs for guaranteed income that Social Security or a pension, if you still got the luxury of that, won't cover. Being able to navigate and find all the ins and outs and figure out how it is going to work for you, if at all, is something that the team at the Retirement Guys Formula can help you with. Being able to say, these aren't suitable for what you need. These will work for you. Or you may be in a situation, as I mentioned, where you may not necessarily need one at all, but you don't know until you have a conversation with a team like the Retirement Guys Formula. Fiduciaries acting in your best interest, not going to put you in a strategy or vehicle just for the sake of them or for the company, but making sure it is truly going to work best for you. It all begins with that phone call, 419-794-3030. Once again, that's 419-794-3030. Or you can go online and find out more about the team and schedule a time, arhq.com. Want to thank you for joining us here on America's Retirement Headquarters. It is the home of the Retirement Guys Formula and America's Medicare Associates. Hope you have a great week ahead of you. Really do appreciate you spending part of it with us. Be safe out there. Dave, grateful for the time as well. And as we wrap up here, I want to leave you with the final word.
With summer winding down, take advantage of these last months of good weather and enjoy time with your family and do the things that you like to do. College football is going to be starting pretty soon and all the fall sports. So it's always an exciting time of year, and make sure you enjoy it.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.